Hey there, everyone. It's Mitch Goldberg. We are live, better late than never. I apologize. Couple of minutes running behind. The days are going by fast. I know everybody says they're bored and, how much time people, not everyone, I mean, I'm stereotyping. A lot of people have time on their hands. And it's still semi quarantine at this point. We have our phases coming through in New York, and most all 50 states are in some form of reopening. But I have to tell you, the days have flown by. The last 3 months have flown by. I've been busier than ever. And look, I'm grateful for being busy. I'm not trying to say like, oh wow, look at me. I'm busy. That's great. You're not. No, I know there's a lot of people who would like to be busier, but I'm in the market. I have clients. Business goes on, and it's just been an extraordinarily busy time. I swore to myself that I'm going to, let me take a step back. A lot of people who I am connected with have said that they're going to really use this time wisely that they have gotten unfortunately, from the pandemic. So people have committed to spending time on doing all kinds of things, projects, family, business ideas, side hustles, etc. And my thing is, I think that the last 3 months have been probably the greatest time ever to be a content creator and active on social media ever. And what I committed to myself is I am going to make sure that I do this right, that I use every minute I have productively. And I have to say, it's been an exhaustive journey, but I have done a live stream every day since a month before the state started to close. It's been about 4 months, and I've been doing live streaming before that, but consistently daily. It is a grind, but it's a labor of love, and I'm thrilled to do it. So anyway, let's get into it. Today, I want to talk to you about exchange traded funds, in particular ESG, environmental, social, and governance policies. Companies that excel in these areas are believed to give investors an advantage in terms of investment performance, and these companies do better. I'm all for it, but I don't really buy the thesis that you have to be in funds called ESG. And once you see what they're made of and how they work, they are more of what they exclude, which is fine. But I find that a lot of these funds are made up predominantly of tech stocks and, developmental stage and innovations. But that's fine. That's great. But you're basically investing in, I think, high tech, aggressive funds. So, we used to call it innovation funds. Hey, good afternoon, Jerry. Good to see you. We used to call these innovation and tech funds, and now we like to call them ESG. So there's a reason why ESG has done well. So let's just roll the intro, and I'm going to make this quick and dirty. Okay. So let's get that going. You're going to want to stick around for that. And we're back. Thank you very much. You're watching a live stream right now. As I come to you, I'm doing this live. I call my live stream Be the Boss of Your Money, because I want you to be the boss of your money, not your money to be the boss of you. Got a couple of things to talk about. What I have up here is the Invesco Wilder Hill Clean Energy ETF. So clean energy, it's in that ESG area, especially and obviously for the environmental part. And year to date, let's just scroll this up a little bit. Year to date, it's up 12.8%. That is pretty darn good, up 31 point, just about 32% in the last year. Expense ratio 0.7. I mean, I don't think it's particularly low, but with the great performance, right? I guess we can accept a higher expense ratio, except for one thing. Hopefully this will come up quickly. But I remember this when it was an $80 stock. a long time ago when the price of oil was like $140 a share. Okay, see this, it was over 100. All right, and that's around when oil went to $140, $147 per barrel, rather. So the reason I don't particularly love clean energy investments a lot is because they typically move with the price of oil. They're correlated. So when oil goes up, people rush into clean energy, and think, oh well, now people are going to want clean energy, and we better buy these stocks because business will be good for them. So when oil goes low, often what happens is clean energy goes down. So if you look at a long-term chart from 100 down to where it is now, it hasn't been such a great ride for investors, except for those who've gotten in, let's say in the last year or two. But ESG is, I wrote an article actually about ESG investing for CNBC. I'll post it in the description, either if you're watching this on YouTube or if you're watching this on social media. I'll post it above in the description and social media, below in the description on YouTube. But basically, ESG funds about a year ago had about maybe $10 to $12 billion invested. Maybe this year it's going to reach 20 or 30 billion. It's growing pretty rapidly, and it's one of the faster growing parts of the ETF industry, which in and of itself has been growing rapidly, but it's definitely been hitting the law of large numbers. So the ETF sponsors are always looking for ways to bring in more assets and grow the industry. Okay, so that's one. Another one is it's not one I use, the Barclays Ipath Global Carbon Index portfolio, and it hasn't been around that long. But the only reason the chart looks like that is because when you scroll like that, it makes it a lot smaller. But did you see that this one is up about 48% year to date, down 5.6%, nothing special. Tan is solar power. So we had clean energy before, but there was a lot of wind power. This is solar power. Come on, work a little faster. It's more of an overview of what I think the ESG funds are doing for people. But when I look at these ESG funds, what I am finding, this one's up 13% year to date. So that's pretty good. I don't know if you could see this. It might look a little small, expand on this. But if you take a look at ETF.com, you can find out so much of what you want to do for exchange traded funds, for a list of exchange traded funds and performance, and which funds are getting the most amount of money, which funds are getting hit with the most redemptions. All right, so you go to the ETF list. I typed in ESG and 3-month total return, which is a very short-term way to look at it. You see 75%, 61%, and 60%. So should you buy these ETFs? Because clearly ESG has become very popular and it's become very desirable with investors. I'm going to say no. I'm not specifically saying no to these ETFs. What I'm saying no to is, as a theme, and there's an ETF that focuses on companies that promote women to executive positions. The symbol is apropos of that is she. Vanguard has the main, one of the main United States domestic large cap ESG funds. Vanguard has it. iShares has it. And you're starting to see ESG funds pop up all over the place. And I hate to say it, but it's the same old. I think that it's a really good marketing pitch. And what you're basically doing is you're buying tech heavy funds. Now, if you want a tech heavy fund, if you really want to go for technology, then you could just buy a technology ETF. XLK, for example, is the Spiders ETF. It's a very popular ETF that tracks technology stocks. There are a lot of ways to invest in technology, but basically, when you're getting into these companies, you're getting into areas that could run hot because a lot of money goes into them. And what happens often is money that went into them comes out just as quickly. So I'm not a huge fan of ESG investing. ESG works now in a way because of what it includes. Technology companies happen to be more inclusive of women in board positions. They still have a long way to go. Don't get me wrong. Okay, yeah, I know you're not getting me wrong there. Okay, so they have that, and they also aren't carbon type companies. They're not like UPS or think of a company that uses up a lot of carbon, like a steel company or a cement company or just an oil drilling company. So you eliminate those. So in a way, since natural resources have not been doing well and fossil fuel investments have not been doing well, ESG has been a good screener to eliminate stocks that, sectors that have done very poorly. But that could change and that can turn around. And I've spoken to people about ESG, and one of the things is it's very subjective. Like, well, you want a company that doesn't pollute the environment. You want a company that helps the environment. You want a company that promotes women and minorities. You want a company that is, creates, let's say, natural organic products. But it's very hard to find a company with all of those. Typically, you have to compromise. So let's say, would you buy a weapons manufacturer like missiles and F-18s and military crafts, destroyers, jets, whatever. Okay, F-22 Raptor. A lot of people would say, no, I don't want that. That doesn't, in my mind, spark ESG. Yet Lockheed Martin, Raytheon, and Grumman, Northrop Grumman, are all headed by women CEOs. So they score very well for ESG marks because they've promoted women to the top position. But look at the business they're in. So would you want to buy a tobacco company if they promoted women and minorities? But you might be like, hey, but I don't want, that's like selling toxic waste. It's like putting toxic waste in your lungs when you smoke. So there's a lot to be desired. And ESG, for me, is something that is so unbelievably subjective. And to truly be ESG, you really have to have such a value proposition to get consumers to pay more for your products. Just like think of organic foods and Whole Foods. And now, organic foods was like a very big buzzword about 5 to 10 years ago. And now it's like, yes, organic is good. It's important, but you can get organic food almost everywhere. And it's not really that much of a premium anymore. So I'm not a huge fan of investing based on ESG. I'm not a fan of companies that pollute and don't promote women and minorities and don't see themselves as having some kind of positive social role or some kind of role model position and corporate responsibility. So that's very important to me. But I don't think you need a fund that says ESG. I think it's so subjective that one person's view of ESG is another person's complete opposite view of ESG. It's like abstract art. One person can look at abstract art and say it's garbage, and the next person can look at abstract art and say, hey, isn't that a Picasso? So that's really what you have to go by. As far as ESG funds specifically, just take a look. These are very aggressive growth, tech-heavy type funds. So if you have a portfolio that is 20 or 30 or 40% or more in funds that actually have the name, the letters ESG within the name of the mutual fund or ETF, you are most likely taking on a lot of what we call concentration risk when you have a lot of money in one particular sector. So that's it for today. Be careful with ESG funds. I appreciate everybody who took the time to take a look at this. I'm not going to be pushing anything. Andrew's out there. Wouldn't clean energy have a negative correlation with the price of crude oil? No. You would think that. By the way, Andrew, I love looking at your Facebook profile picture. It's just so awesome. But you would think that no, but when energy goes up, when oil goes up, um, environmental type companies, uh, clean energy companies, okay, they go up also because that's when they prove to be value. Because they're going to save you money. I remember in around 2007, 2008, a friend of mine sold a used Toyota Prius for $30,000, which was like $8,000 more than a new one, because you couldn't get them, but people were desperate for the Priuses because people thought literally right around when Lehman Brothers blew up, people thought that oil was going to run out. That was a concern. Believe it or not, about 11, 12 years ago, there was a concern that the world would run out of oil. I mean, I remember there was a special on CNBC called Over a Barrel, a special. Carl Quintanilla, I think, was the host of it. And they talked about how the world is running out of oil. And James Woolley, former head of the CIA, had all solar and water wells on his property. And he was just like ready to be completely off the grid. And people were worried that the world was running out of oil and it was going to destroy our way of life here in the U.S. It turns out we have more oil than we can possibly absorb. We don't have enough demand for all the supply, as you know, Andrew, and which means that there's less of an incentive to go clean energy. Witness all the type of vehicles that American consumers purchase. All right, so that's really about it. It's kind of a boring subject, I guess, because no one's really asking me anything. So I'm going to go. Keep in mind that Fridays, probably through October, I'm not going to be doing a live stream unless something really batshit crazy happens in the world. It's kind of a slow period right now. It's June 18th or June 3rd or so is when we get our next non-farm payroll figures. I don't know is that a national holiday because of the way July 4th falls on a Saturday. So, but we're going to start seeing earnings come out around July 7th, July 8th. We're going to start seeing first quarter earnings come out en masse. And that's when you're going to start to see more fireworks. So I do expect a pretty quiet 2 weeks coming up. Hey, I'm not going anywhere. I'm not taking vacation. I'm not taking my eye off the ball because you never know what's going to happen. But I do think it'll be pretty quiet over the next 2 weeks until we see the next non-farm payroll number come out and Q2 corporate earnings, which we already expect to be pretty lousy, but maybe expectations are so low that we could see some beats. And then we have to see what companies are saying about the states reopenings and what they see going on in the third and fourth quarter for the year. All right. I will speak to you guys soon. I really appreciate you joining me here every day. Thank you.